Our next speaker is Rhys Wilson, our host, who is a partner in the law firm of Nelson Mullins, Riley, and Scarborough, our host for today. Nelson Mullins is one of the country's largest law firms with over 750 lawyers in 25 offices from coast to coast. And Rhys is the co-chair of the Nelson Mullins Mergers and Acquisitions Group. That group closed 176 M&A deals over the past 2 years with a value of $8 billion with a B, someone said earlier. Rhys has been selected by his peers as a Georgia super lawyer in mergers and acquisitions and is one of the best lawyers in America. He's also been a Vistage member for over 20 years. That is a milestone. I think he joined when he was 10. The focus of his practice is on helping clients buy and sell businesses. Rhys is going to show us, based on his nearly 40 years of experience, the top M&A deal killers and how to avoid them. Rhys.
Well, as Linda said, my job is to help people buy and sell businesses, and the best days in my practice are the days when we close a deal. And that's accumulation. You saw the process that Collier laid out here. It's accumulation for the seller of 20 years or more in some cases of hard work building a business and getting to that payday. For a buyer, they really want this company. They've been chasing it. They've gone through this competitive process. They've won the process. Yay, they've got the company. The advisors, well, we get paid. So we're happy. So all of those fierce conversations that have happened over the past several months, all is forgotten. It's all sweetness and light. Those are the best days. The worst days, and thankfully I haven't had many of these, is when a deal dies. And it feels like death to everybody. Again, the buyer comes away empty-handed. The seller isn't able to exit. Both have invested tremendous amounts of time, energy, effort, and money in this process that has failed. So what I'm here today to do is to tell you what are the things that kill deals so that, number one, you can spot them if you happen to have one in your business, and number two, you know how to fix it and avoid it. So, by the way, this is the audience participation part of the summit. And we're going to go Family Feud style. So here we go. What's the number one top M&A deal killer? Just shout them out. Come on, here we go. Keep coming. Come on. Wow, these are all excellent answers. Here is the correct answer. Accounting errors. And you're all going, accounting errors? Are you kidding me? Why would that be? Excellent question. I've never met this man before in my life. The reason is that while buyers look for companies based on all sorts of things, market position, management team, all these other things, in the end, the offer is made based on the financial results of the business. And if those financial results are distorted in some way, then the offer gets distorted in some way. Often offers are expressed in terms of a multiple of adjusted EBITDA. If your EBITDA is not calculated properly, then the offer is wrong. And that can then lead to all sorts of problems. Now, why is it so critical that your financials be based on GAAP, generally accepted accounting principles? Well, first of all, again, it's apples to apples. The buyer is using GAAP financials. They're looking at other companies and they're basing all their analysis on GAAP. In addition to that, almost every buyer uses some amount of debt in doing a deal. So they have to borrow money, they have to go to a bank. A bank is going to insist that all the things presented to them are based on generally accepted accounting principles. Public companies, they have to announce the impact on earnings as soon as the deal closes, and then they've got 90 days to push your financials into their financials. So they need it to all be in accordance with GAAP. So how do buyers figure out whether or not your financials match with GAAP? This is Collier mentioned this. It's called the quality of earnings analysis. And what they're looking for there are these accounting errors. So here are some of the examples we've seen and the ones that cause real problems. And the first is the old GIGO, garbage in, garbage out. And that is often it's people who are either not properly trained entering transaction data, or their accountants just simply didn't give them guidance, or they never talked to the accountants about how to do it, and they've got a bunch of junk in their financials in terms of, for example, what is the cost of our inventory? Well, if you buy some components here, buy some components there, and we do some work here, and you put it all together, if you don't account for that properly, your costing is all wrong. And we had one deal where they had to go back and manually re-enter an entire year's worth of inventory. both costs and sales. So needless to say, that one got dead, okay? So the other big one we see are revenue recognition errors. And you say, well, how complicated can that be? Well, you'd be surprised. For example, if you got a software business that does annual renewals, well, in January, you book all the annual renewal revenue. Yay. And then over the course of the year, you spend money, and so you book the money you spent. Well, those financials look great in January, right? But come December, maybe not so great. Well, that's not GAAP. GAAP requires you to spread that revenue ratably over the year and match it up with the costs. So if they don't match up, it's a big distortion of your EBITDA. By the way, this is about to get a lot worse because this year, all the revenue recognition rules changed. So if you haven't talked to your accountants about how you recognize revenue in your business, you need to do that now. So there are other non-GAAP issues. A lot of these are more minor, but needless to say, all of these cause problems. So what happens when this Q of E comes in, this accounting firm comes in and finds all of these non-GAAP accounting errors? Well, all of a sudden your EBITDA goes down. And you heard Trey talk about anchoring. Well, if you've got 30 million in your mind, and the Q of E says, oh, well, your EBITDA is $1 million less than you thought, all of a sudden that price drops to 24 million. And even though you probably would have been happy with 24 million, 5 years ago, 30, it looks terrible now. And this will flat kill a deal. Because, what do you do? Do you go forward at the lower price or do you pull? So we face this all the time with folks. So what do you do? Get audited financials. I'm telling you, how many years have you been listening to me tell you, get audited financials? And sometimes I hear accountants say, oh, well, you don't really need audited financials. They're wrong. Get audited financials. This takes care of the problem. And everybody's like, well, it costs so much. It doesn't cost a fraction of what it's going to cost you if you go into a process and a Q of E determines you got non-GAAP financials. $6 million? Audits don't cost $6 million. No, I can tell you, you'll spend more on legal fees negotiating the working capital adjustment if you don't have GAAP financials than you would have spent on 3 years of audits. So I'm telling you, get audited financials. That will take care of that problem. So that's deal killer number one. Okay, deal killer number two. What we got? Come on, fire them at me again. Let's go. Come on. Come on. Oh, don't be bashful. Come on. All right, never mind. Here we go. All right, number two. Tax problems. And everybody thinks, oh, well, income tax, right? Wrong. Sales taxes. This is the single biggest issue we see consistently on the tax side, which is people who are selling in multiple states. And up until this time, they've been told, hey, if you don't have a physical presence in that state, you don't have to collect sales taxes and remit them to the state, right? Hey, easy, right? That's great. I mean, you save whatever hassle there is of doing that. Your customers are happy because they don't pay the sales tax, and of course they don't pay use tax either, so they just save money, right? That's all great until you go to sell your business. The problem is that the buyers, if it's a strategic buyer, they probably have nexus in all states. If it's a private equity group, they're going to want to have nexus in all states because they're going to want to expand the business and grow it. And so they're going to look at this situation and say, guys, we're going to start filing sales tax returns in all of these states where you're doing business right now, either now or in the future. And we're not going to take the hit when the tax guys come and say, hey, we just saw you filed a state sales tax returns. Where are all the sales tax returns from all the other years you were selling in here? So what they do is they make you enter into voluntary disclosure agreements with all those states, pay all those sales taxes, which, by the way, your customers should have paid that sales tax. That's really their expense, but because you didn't collect it, you're liable. That's how the sales tax situation works. Now, so what do you do in this situation? Same deal. You got the anchoring issue. This one's not as big as the one on EBITDA, but it's a big issue, and it has come very close. We had one deal almost die on this one. So, oh, by the way, this is about to get a lot worse. Heard about the Wayfair case, the Supreme Court case? Well, all those things that your accountants used to tell you about nexus are now wrong, because the Supreme Court said that nexus can be established by not only a physical presence, but by activity. So if you have a certain number of sales or a certain dollar amount of sales in a particular state, that state can claim nexus, and that state can require you to collect sales taxes. Over 30 states have already passed legislation in response to Wayfair, and I expect it to be 50 before long. And so what's going to happen is all those times you thought you didn't have to file sales taxes, you are going to need to file them now. And you need to be aware that more and more states are taxing services. If you're in the software business, you may have thought, oh, I'm providing that over the cloud. I don't have to collect sales taxes. Wrong. Wrong. You're going to have Nexus now if you have a certain number of transactions, certain number of dollar sales. You're going to be required to collect sales tax. So you say, well, gee, I'm a wholesaler. I don't sell to end users. Well, you got to prove that. And the way you prove that is by having an exemption certificate. And if you don't have that, then you got a problem. So that's the first tax problem. The other big tax problem we see are worker misclassifications. The big one is independent contractors. If you are using independent contractors in your business, people are given 1099s and not W-2s, you are in the target. They are coming after you because this is a big dollar opportunity not only for the feds but also for the states. And the states are all hungry for revenue all the time. So what happens if somebody comes in and finds that you have all these people you're paying as independent contractors, but you're not complying with the law, the 16-point list of factors, I won't bore you with that. But if you're not complying, this is what happens. All of a sudden, those independent contractors become employees, and you owe them all of this back wages, overtime, all this kind of stuff, and you owe the feds and the state in all the income taxes you didn't withhold from those people, Social Security, et cetera, et cetera. This is a big, big number. A smaller number, but also significant, is the difference between the folks that are eligible for overtime and the people that are not eligible for overtime. So you got to make sure that you look for that issue as well. So how do you avoid these two big problems? Well, first of all, you just got to bite the bullet. I'm just telling you, if you're thinking about selling your business, go ahead now, bite the bullet, get these issues addressed, determine what your sales tax liability and sales tax situation is. There are great software programs out there now that can plug right into your accounting package that will allow you to now start collecting and invoicing your customers for these sales taxes and collecting them and then paying the returns in, and also helping you get exemption certificates. And by the way, most states have these VDA programs. If you come to the state voluntarily, they will often waive, at least they'll waive all the interest and penalties. In many cases, they'll waive the prior taxes if you'll just turn yourself in and start paying. So that's how you take care of sales taxes. On worker misclassification, get a lawyer in there who knows this area and knows what goes on here to help you figure out what is going on. You cannot wait until you get into a sales process. And I'm telling you, I had one last year before, died for exactly this reason. The folks had independent contractors. They were not treating them as employees, and the deal went away. So again here, there's a voluntary program with the IRS and with most states. Again, just attack the problem head on and get it taken care of. Okay. All right, number 3. So you thought both of these were underwhelming. Well, wait till you see this one. Okay. Botched exit plans. Okay, well, how do you botch an exit plan? Well, first of all, don't have one. And that's a lot of people don't have one, and certainly don't have a written one. Well, why do you need one? Well, I'm a big Covey fan, and it's begin with the end in mind, okay? How do you run your business? If you're planning on selling your business, you run it one way. You build a management team. You go for extra revenues. You bring in chief outsiders. You do all these things to try to drive this thing forward, to drive that top line and really go forward and create this great growth story. But hey, if you're just going to hold on to this thing until you die, well, why go do all that? Why not just milk it? You got to decide what your exit plan is, because that then drives or should drive a lot of your decisions. The other way you can botch an exit plan is by assuming that your partners have the same plan that you do. That's a big mistake. And Patrick Ungashik wrote a wonderful little book on this, A Tale of Two Owners. It's a great beach read, believe it or not. Take it, read it. If you've got a partner in your business, it'll really help you get that perspective. By the way, spouses, children, other family members, they kind of fall into this category too, whether they own stock or not. You'd be surprised how what you think is the right exit plan is not what they want. So that's another way to kind of blow this thing up, is by making that assumption. The third way to mess it up is having the wrong advisors. If you're thinking about selling your business, get advisors who help people sell businesses, okay? If you don't, you're going to get bad advice. You're going to miss out on opportunities. You're going to leave dollars on the table. It's going to cost you a lot of money and potentially kill your exit. And this happens all the time when people have the wrong advisors. They mess up the exit. The other issue you can have is not having advisors who are aligned with your exit plan. So the classic example of this, no offense to other members of my profession, is your corporate lawyer for whom you happen to be his or her biggest client, who is now in charge of helping you sell your business. Wonder how that's going to go. Yeah, so bad idea. The other one is just not telling your advisors what your exit plan is. So again, they're giving you the wrong advice, thinking that you want to do X when you really want to do Y. So you got to deal with that. And then the other one is, and this one is the penny wise, pound foolish, of just not using your advisors, not bringing them in early enough, pushing this off until when you're just ready to start the process. Well, you see all those deal killers I talked about before? All of those can be fixed with time. But if you don't give us time, we can't fix them. And what it's going to do is push off your exit to a later date when we could have fixed it all within, say, 1 or 2 years. We could have all that stuff wrapped up, completely clean, ready to go to market. So how do you avoid this, the number 3 biggest deal killer? First of all, have a complete written exit plan. And then, oh, by the way, don't just put that on a shelf, implement it. And this is the hard part. And by the way, the folks at Whitehorse or Navix, they are brilliant at this, both at helping you prepare a plan, but most importantly, helping you implement the plan. Because too many people just won't do these things. They're important, but they're not urgent, so they never get done, right? These guys show up every month and say, okay, they're holding you accountable, just like Vistage does. Same model of, hey, I'm here. You said you were going to do this. Did you do it? Yes or no? It's amazing how things get done with accountability. So if you're planning on selling, and you're going to sell to a strategic buyer, a private equity group, a third party, get the right advisors, engage them early in the process, have a wealth management firm. One of the keys to any exit plan is determining what is your minimum sale price. This is a very difficult calculation. Ballantine is brilliant at it. They can help you figure out exactly how much money you're going to need to be able to live for the rest of your life off of the proceeds of this sale. You need an excellent accountant. There are a number of excellent firms in town. Aprio is certainly one of the best. An investment banker, preferably active in your industry. Again, VRA, that's the theme here. VRA is excellent too. You need an estate planning expert to make sure that, to the extent that estate planning is important to you and allowing you to keep more money for the next generation, that's done. Again, this is the kind of thing, if you do it 5 years ahead of a deal, you can do amazing things. 5 minutes ahead of a deal, you can't do much. And then finally, get an M&A attorney, somebody who specializes in this area. If you need a referral, I know somebody who's really good. So if you have the right advisors, the right exit plan, you should be able to avoid these M&A deal killers and be able to have that wonderful, happy, best day of your life. Thanks.